All right. Hey, that's pretty good. Thank you guys for coming. Appreciate y'all being flexible on the schedule. We're trying to just try different times and places out. We're pretty much at capacity here, so thanks for not bringing any other friends. But we're glad to have you guys. In the summertime, we kind of wanted to switch it up a little bit and try to make sure people didn't have to stay late in the evening and listen to us talk. But glad you guys are here. Good presentation, in our opinion, coming up. You may or may not like it, but you can leave us a review afterwards. You're gonna hear from myself, Ben Nye, our Chief Investment Officer, Tom Russell, Director of Fixed Income, Sam Frost is a portfolio manager, he's gonna talk some, and Jason Seeds over there, one of our investment analysts. So gonna hear from a bunch of us, and the theme of the presentation is the heat is on, which is appropriate for the summertime, but also appropriate given where we think we are kind of within the economic backdrop. In May, Atlanta Fed President Raphael Bostic noted that the Fed has not really gotten to the hard part yet. They're going to have to start making more difficult decisions going forward. And that's interesting coming from Bostic because traditionally he is relatively dovish. He's actually pretty recently been in favor of easing monetary conditions. But even he is saying, hey, things are going to get a little bit dicey. We're going to have to make some tougher choices. Great quote from him. We're going to have to be super strong and detached, which is also how my wife describes me. So the heat is very much on. There's some big things hanging in the balance, and there's a lot of directions we could be going. So we are going to do Q&A at the end. Don't worry about the QR code thing. But if you have questions, just hold them for the end, and we'll jump into those. And with that, I will turn it over to Ben.
Thanks, Andrew. Yeah, happy to talk through some of this. It's going to be kind of a popcorn thing, so a few of us are going to be talking, so it should create some variety here. Jay Powell on June 15th said the worst mistake we could make would be to fail, which seems kind of self-explanatory. But he's really referring to inflation here. And he says the worst mistake would be to fail at really bringing inflation down, which, we would agree with is also kind of convenient for him to talk about as inflation is coming down. But we're going to talk a little bit about how the Fed is dealing with that right now. With respect to what the Fed's goal is, so we had very high inflation. So the goal of what the Fed wanted to do was raise interest rates. And immediately when that happened, you saw declines in real earnings on the consumer side. Average hourly earnings for consumers in real dollar terms turned negative last year. If you look at earnings estimates for the S&P 500 in Q1, they were down 2%. In Q2 here, they're estimated to be down 9%. So we are beginning to see some of that. Andrew's going to be talking about a little bit of slower consumption in the economy. And obviously, we've seen some lower business profitability. The question is, can we navigate that and really become a little bit more normal and a little bit more stable, or do we overcorrect and lead to more Fed rate cuts? We would say right now, as we look at the upside and downside risks, the upside risks have actually improved. They're becoming more likely. Inflation has turned down a little bit more meaningfully. Confidence has improved. If you look at CEO confidence, had a little bit of a dip in March, but we actually bottomed in terms of CEO confidence back in November. And today we have higher levels of CEO confidence than we had since 2021. So companies are out there and they're starting to get a little bit more excited about things and starting to think about 2024 and investing a little bit more going forward. And that could bode better for corporate investment going forward. So that's globally. On the personal side, with interest rates being higher, it does present the opportunity to be a little bit more judicious on the personal side, making sure that you're being smart about when you spend money and how you spend money, because now there's a 5% hurdle. If you just buy something next year, especially a big ticket item next year, you can actually make 5% on that money just investing in treasuries over the course of the next 12 months. On equities, the way we're approaching things is continuing to be look for businesses with good cash flow that can weather the cycle. And I think one of the most exciting pieces, and Tom will like this, is that fixed income actually has a return now. And we're going to have toward the end of the presentation, we look at where the fixed income returns and the outlook for fixed income returns. And it's really not something we've seen since the 1990s, where fixed income is as viable an alternative to equities as it is today. So we're going to start with a couple quick updates on the overall economic landscape. Then we're going to talk about some recent events. We're going to be talking about the student loan repayments that are going to be restarting. That's going to be a big issue for some people. We're going to be talking about the US dollar as a reserve currency. We're going to be talking about artificial intelligence. And we're also going to have a little bit of an update on the banking system. And then we'll kind of finish with an outlook for where we see the likely outcome for markets going forward. So with that, we'll just jump in. And we got to start with inflation. Inflation is the big topic of the day, and it is coming down. I think probably people saw that CPI report, the consumer price inflation report yesterday, down to 3%. But importantly, core inflation, which gets rid of food and energy prices, that's still elevated, but that is coming down to 4.8%. So that's good news there. It's falling relatively slowly on those reports, but if you look at the ISM services and ISM manufacturing data, this is where you can really start to see prices coming down a little bit. So what the Institute for Supply Management does is they go out and survey a number of different businesses, and those businesses report whether they see prices going up or going down. And so if more than 50% of these businesses are saying that prices are going up, then you're having a little bit more inflation, and then vice versa. And what you're seeing right now is on the manufacturing side, with freight and logistics prices coming down, with goods prices coming down, you're actually seeing some deflation on the ISM manufacturing reports, and you're seeing some disinflation, which is just lower levels of inflation on the services side as well. And what I think is very interesting about this chart is if you look back to where we were in 2019, on the ISM survey data, we're about back to where we were at that period of time. So I think this bodes fairly well for inflation and some of those national surveys to continue to come down as well. On the economic side, probably one of the biggest pieces of optimism are on those new orders. So I talked a little bit about CEO confidence. You can also see the bottom here in new orders starting to form a bottom here. And I think that gives us some optimism going into the second half of the year and into 2024. There are definitely, there are definitely potential reasons this could change. But on both the services side and the manufacturing side, we're beginning to see people digest where we are in interest rates. The Fed has slowed the rate at which it's raising interest rates, and that's helping on housing demand, that's helping on new orders as well. Employment's relatively steady. Manufacturing has kind of been dipping up and down, and put warehousing in that category as well. But on the services side, you're pretty steady on employment. Angie's going to be talking a little bit more about this now on the job situation, but I think stabilization is kind of the key theme on this front.
Yeah, stabilization is definitely the theme. It's too early in the day for a drinking game, so don't take a shot every time we talk about stabilization or normalization, but take a bite of that mac and cheese every time we do it, and you'll probably pass out about as quickly. So as we look at hiring, we're going to look at this through a couple of lenses. First is looking at stabilization in the form of hiring intentions starting to fall. So on the left side here, you have a chart of small businesses, and this is looking at the number of businesses that are on a net basis looking to add to their payroll versus reduce headcount. And so you can see that we see that coming down quite a bit from the highs that we had, in 2021. We're really at the lowest level we've been since the COVID pandemic, and it's still relatively elevated. This is not a dire situation, but we're seeing things normalize. The other chart on here shows the number of job openings relative to the number of people that say they're looking for a job. When you see this number highly elevated, pushing close to 2 open jobs per prospective hire, that's a sign that the control is really lying with the employees. Hey, I don't have a job, but there's 2 openings for me. I can be kind of picky and choosy. I can pick what my salary is going to be a little bit more. I can kind of have some control there. But we're starting to see that, and I think I'm actually off on the slide. I apologize. These are job postings on Indeed, so forget everything I just said and
Now we'll talk about that point. So when you're thinking about that, though, we can see that not that long ago, there was 2 openings for every person that was seeking a job. And so we've seen some normalization starting to come back down. And that really does mean a big transition away from empowering just to the employees. Employers are starting to get some of that control back. And you see that really positioned well here. So this is a chart of pay increases for job switchers, job stayers, and the overall economy. And we've been talking about this in the macro presentation, certainly going back into last year, maybe even the year before. For a long period, this orange line was the pay increase you could expect kind of across the whole economy for switching jobs. When there's 2 openings for every 1 potential hire, you've got a lot of control. You can, kind of pull the strings as you see fit, and you have a lot of control as an employee. We're seeing that start to normalize. The reality is you would always expect that line to be slightly higher than the overall rate of pay increase, because there is an element in which people should be leaving their job for more money. But for the last couple of years, it's been extremely, extremely exaggerated. And so we're seeing 2 trends here. One, that orange line is starting to fall. It's no longer as advantageous on a relative basis to just switch jobs. The other thing we're seeing is we're seeing stabilization in wages in general. No matter what line you're looking at, compared to late 2022, we're seeing some stabilization as it relates to wages. We're seeing that, and we're also seeing a positive trend for employees in that real hourly earnings are stabilizing and actually ticking up. And what this means is you now have more disposable income than you had a year ago. If you go back to our macro presentation a year ago, you're basically looking at kind of this bottom dip in that line in terms of what real hourly wages were doing. And the reason for that was inflation was so rampant that it was almost impossible for you to get a pay increase that kept up with it. Now that's not necessarily the case. Talking with peers and folks that I know in the industry and in other industries, big pay increases now are meaningful because inflation is not what it was a year ago. A year ago, an 8% pay increase may not have meant anything to what your take-home pay was. Now it does mean something. It may not mean I'm getting 8% more in take-home pay, but it means you're getting, an additional 3, 4, 5%, depending on kind of your basket and your own personal CPI. And so that's a favorable thing. And that is helping the savings picture. Earlier this year, we talked about some concerns we had specifically as it related to the depletion of excess savings. Savings were built up to record levels, literally, in 2020 because of the COVID stimulus checks. People were getting enhanced unemployment. They were getting checks in their mailbox, things deposited into their accounts on a pretty recurring basis. And so we built up a massive amount of savings. Well, then inflation came into play, and we started rapidly declining in terms of savings. But we're seeing some normalization. You've got these huge peaks as it relates to kind of those COVID stimulus packages in terms of savings as a percentage of disposable income. And then you really fell off. Well, we're starting to uptick a little bit. We're starting to stabilize there. That's a good thing. This chart on the right, the bar chart, is pretty interesting because it identifies households based on income levels. And it basically is trying to identify who's actually saving money. And so this is a chart of inflows to outflows. And so if you're over 1, it means you're actually saving some of your money. And really every cohort other than those under $50,000 of income a year have been saving money. The challenge, and what we're going to talk more about later in the presentation, is that a big impact is coming in the form of the resumption of student loan payments. The red chart is predictive of what it looks like when you start actually paying those student loans. And so it's going to have a pretty significant impact. We started the year very, very strong from a consumer level. The orange line here is tracking dollar volume, which really is kind of a byproduct of the number of transactions and the ticket price. We started off very strong, a lot of activity, pretty high prices. We've seen prices fall a bit, and we've seen some stabilization. But really in June, for the first time since January, we are actually seeing a little bit of an uptick in terms of transactions and in terms of dollar volume. And so some of that savings picture, we've had this backward looking data where we saved a ton during COVID, then we started spending. As we look at it now, it does seem like some consumers are coming back online, so to speak, in terms of volume. So there is a bit of an uptick there. And what we really want to watch out for is credit quality.
We really want to avoid a credit crunch in which people can no longer afford to make their debt payments. So the orange line here is essentially an approximation of how many months of savings would it take American people to pay off credit card debt or revolving debt. And you can see where those numbers have been historically, and you can kind of get an idea and a feel for it. And you can see here, when you look at how many months of savings people needed just to pay off their credit cards, going back as early as 05 and 06, you can see why the problems of 08 and 09 were exacerbated. We started to see a real uptick in this data late last year, but we're now seeing that level off and fall a bit. Interestingly, delinquencies still very, very low as it relates to being 30 plus days late on card payments. So we're seeing some stabilization there as well, and we think that's a positive thing. A big part of the consumer spending picture, obviously, is on the home building side. Right now, just recently, for the first time in the last 12 months, the average nationwide sale was higher than listing pricing. We were talking about this a little bit earlier, but we're seeing a really interesting dynamic in the real estate market in which essentially a lack of inventory for sale. Listings are down 25% year over year. The lack of inventory for sale is completely offsetting at this point the much higher interest rate environment that we are in. But we think this is actually, at least for the short term, relatively healthy. This is the Redfin Homebuyer Demand Index. You've seen a lot of choppiness. The red is 2022, so last year, very, very high early in the year, then plummeted as interest rates really increased. What's encouraging in a way to us is that although we're in a very interesting and challenging interest rate environment, we're seeing a lot of stabilization and we're pretty range bound. And compared to recent years, demand for homes actually seems pretty calm, pretty understandable, pretty digestible. I mean, the gray line is 2020, and you think of COVID, I mean, you see this thing basically go to zero and then take off like a rocket ship. We're just kind of hovering really tight right now. And so there is going to be a continued challenge with inventory. We were underbuilt for a decade plus. That hasn't changed. It's more difficult for some home builders to get financing for acquisitions. Now that interest rates are higher, it's harder to buy lots, develop them, all that kind of stuff. You're going to do less of that on spec if you're paying 8, 9, 10% interest as opposed to 3, 4, 5. And so the demand challenge is stabilizing, but the supply is still very murky. And I think that's really going to probably keep real estate propped up even in this environment. With that, I will turn it over to Finn.
Yeah, so there's a chart that goes all the way back to the 1980s. Right now, it's crazy how quickly mortgage rates move. Just last week, I think they popped into the 7s. Maybe they've come down a little bit after the inflation reports last couple of days. But I think the big takeaway from a lot of these areas is the fact that change is really tough for people. It's exceptionally difficult for markets. So changes in the cost of funds really disrupts markets, and that's what you saw last year. And I think if you look back over the last 6 months and say, well, why has the stock market and why has the economy seen some stabilization when we thought we were going to go into a recession? It's because we have seen a little bit more stabilization in those rates, and that inflation level is starting to come down. And as a result, even with high levels of mortgage rates, because those mortgage rates have been steady for longer, people are kind of used to that, and they're just saying, well, this is the reality now. That's what I'm going to pay. We look back into architectural billing. So this is an AIA report that comes out every month. We only have data through May on this report, but you can see again in November things kind of bottomed out. So this is your billings, and then you also have your design contracts. We'll talk about inquiries in a second. You did see a little bit of a pullback associated with the banking issues in March, but that has since started to improve. What's interesting here, though, is a couple things. AIA also breaks it down by sector. So you have the institutional, which think government and education. You have commercial and industrial, and then you have commercial real estate. Real estate is quite poor right now, and it has not bounced much at all in terms of people looking to buy, build more multifamily properties. or office properties. That market's very, very difficult. Commercial industrial is beginning to improve, but the institutional side, government and education, is really thriving. So when everyone got their assessment for their property taxes this year and saw that jump in property values, this is what the governments are seeing, and they're redeploying that capital. And so we're seeing improvement in certain parts of the architectural, construction, and engineering space, but it's in different pockets. And so I think that's an important discrepancy to discern. And if we're looking what's going to happen over the next 6 months, there's a lot of inquiries being made to get quotes to build new projects. So there's a lot of interest in that space, and I think it does bode fairly well that people want to invest. We see this married with that new order data that we talked about. We see it married with the CEO confidence data that we talked about. And so we do see an improvement in certain business conditions as a result. That said, there are some concerns on the real estate side. Just as I was mentioning on the being able to discern between those sectors. And one of the concerns is that private real estate discount rates have not adapted to this rate reality yet. Bank of America did an analysis here. The lines are difficult to see, but I think everyone can see the difference between, on that left chart, the light blue and the yellow and the dark blue. The dark blue is the cap rate in private markets right now, and that's around 4.5 to 5.25%. The light blue and the yellow is the implied cap rate for publicly traded. This is Camden Property, one of the big multifamily real REITs here, and they're local, and that's closer to 6%. So you say, well, 5% to 6%, that doesn't sound like a lot. Well, in terms of value, if you're taking the reciprocal of that, you're talking about a 20% change in value. And then with the leverage on top of that, that could be big haircuts on equity values for some of these developers. And this is why you're not seeing very strong demand in terms of multifamily and real estate construction right now, because those costs of funds are so high. Tom, you want to talk a little bit more interest rates?
All right, so let's talk about the Fed. We're probably going to continue to talk about the Fed until inflation is resolved, and then everyone will forget the Fed exists again for another 10 years. But what we have here is every 3 months, the Federal Reserve publishes what they call the Summary of Economic Projections, which is essentially what they think is going to happen in terms of growth, inflation, and where they're going to be in terms of their funds rate. So on the left-hand column, we got where we are basically year to date. So GDP is roughly around 2%, the unemployment is at 3.6%, and these inflation numbers, core is a little bit higher, but inflation is roughly at 3%, and we're sitting at 5.1% on the federal funds rate. So that's a range. Their target right now is 5 to 5.25. So what you can see here is they basically expect the second half to be extremely slow in growth, a little bit better in 2024, and then we kind of get back to growing in 2025. They expect inflation to be 2.5% next year, kind of getting their target in 25. But the big number here is 5.6, the bottom of the second column, which is they're projecting right now that they're going to raise interest rates 2 more times. If you look at the futures market right now, we expect almost 100% probability that that's going to happen during the July meeting. And then the second hike will likely be in the November meeting. So they did their hawkish skip. They did not raise interest rates. The likelihood is that they're going to raise again in July, wait 4 months, and then raise again in November. But it's important to take this with a grain of salt, because if you look at this same chart from early 2023, they expected by the end of 2023 for inflation to be at 2%, and they expected that they were going to raise interest rates exactly 3 times to 0.75%. So it's important to know what the Fed thinks is going to happen, but it's also important to know that they're extremely bad at predicting what's going to happen. So we take caution when looking at these, but I think this is a far more realistic projection. Now that we've had all these rate hikes, the economy is starting to adjust to higher interest rates, that this is probably more in line with what was going to happen the whole time than what they thought was going to happen at the beginning of last year. So when we talk about whether we have loose monetary policy or tight monetary policy, real interest rates is basically the visualization of that. So if you look, all the way back the last 10 years, back in 2020, when they cut rates to 0, we were in extremely loose interest rate policy, and now we've tightened. We've basically peaked out in October, but we're a little bit tighter now, and we think there's a lot of risk that they will continue to have tighter and tighter economic or monetary policy. And what does that mean exactly? Well, the way we value companies, the way a lot of the stock market values companies, is using discounted cash flows. So the higher your real rate, the less your future cash flows are worth. If you look back at your economics class in high school where they said, Bobby wants to give you $5 in 5 years, how much is that worth at a 3% discount rate? Well, the higher the discount rate, the less that money is worth right now, that money in the future. And so what's happened is, if you look at, Ben said we're expecting earnings per share to be down 9% this year in the stock market. Well, last year they were up 13% and the stock market was down almost 20%. And the reason for that is everyone had to look around and say, at this new real interest rate, how do we value those future cash flows? And the answer is they're worth a lot less. And so now as the market is starting to digest higher real interest rates, we're starting to reset at a base and say, hey, well, the likelihood that, NVIDIA's earnings per share in 5 years is X, well, that kind of gives us a stock price of right around $400. And so, at the longer we stay here and we don't see massive volatility, we can have more stable stock markets. But if this number continues to rise up, we're going to have to continuously reevaluate the prices of stocks. The next biggest piece, probably second to the Fed, and the one that people really don't talk about, is the M2 money supply. And Ben, earlier this year, went and sat in at Georgia Tech. They had Dennis Lockhart, who's a former voting member of the Fed. And there was a question asked about whether or not the Fed looks at the M2 money supply. And the answer was they don't look at it or think about it at all. But when you think of what the Fed does when they do quantitative easing and loose monetary policies, they're literally printing dollars. They create dollars out of thin air. And they go out in the economy. And what we had over the last couple of years is just, trillions and trillions of dollars sloshing around the economy. You can see 2020, they say, we're doing $2 trillion in stimulus. Well, that's what it looks like. The Fed prints that $2 trillion and it goes out and it goes into banks. People use it to buy stocks. They use it to buy Nikes. It basically just floods the market with dollars. But for the first time in recorded history, we're actually seeing a regression in the number of dollars in the economy. And that's never happened before. So yesterday, Seth Klarman was talking to Jim Grant. So Seth Klarman's a big hedge fund guy. Jim Grant is a boring interest rate guy. But basically he said it's almost like the introduction of sabermetrics to baseball. We looked at it one way for a very long time. We thought RBIs were great. And then we realized that there's a totally different way of looking at this. And that's how we're entering the new regime. Is we're suddenly in a position where we have less dollars on the books than we had before. And what does that look like? Well, it looks like bank failures. So you can see here, where do those dollars go, right? They go into the banks. And we saw earlier this year that when people start pulling deposits out, when the number of dollars that are in the banking system starts to contract, well, we see real problems because, these banks have invested for the long term. They want to make net interest income on the deposits they have. But as the deposits flood out and the value of the bonds that they purchased are also degrading, you get in a situation where you don't have enough equity to cover the loans you have outstanding, and we see banks start to fail. So you can see here, this is a pretty alarming number that we're seeing lots and lots of money flow out of banks. And the higher that real interest rate becomes, the more difficult it is for banks to stay solvent. And so we want to make sure that we're keeping an eye on this, both the M2 money supply and the number of deposits, particularly if the Fed is going to continue to raise rates and if they don't have a good gauge of how many times they're going to actually raise rates. And this is a little bit of a summary of why do deposits matter. Right now, we're going to see a market change in the tightness of lending standards. We look at something called the SLOOS report, which is a survey of banks, and they basically say on different types of loans, how much tighter are you in lending standards than you were before? And it's going to get pretty grim because if you know that you can get 5% putting your money in treasuries or putting it into a money market account, you've got to have a reason to make more money than that. And the bank does too, because they've got to pay you that rate. So they've got to raise the interest rates on the number of loans that they're issuing. And not only that, they've got to make sure that they're not going to lose money on those loans. And so it becomes a much more difficult prospect to run a bank and to make money in a tighter monetary policy regime. And we just haven't seen that since 2008. And we've never seen the M2 money supply contract in the way that it was. So there's a lot of moving parts. We already saw this year a number of banks fail. If interest rates continue to march higher, I think there's going to be more pressure there. And so if you're a bank and you're not operating at a high level and you haven't said, hey, we've got a bunch of really bad loans, we've got a bunch of really bad investments on a fixed income side that we need to jettison in order to make that money, then we're going to be in a tough spot and we're going to see more bank failures. So the Fed is obviously aware of this. I know that they're working aggressively to make it look either like banks are in a good position while they work on making them actually that way. But this is a major point, and Ben's going to jump in and talk about banks.
Yeah, I think this is an interesting quote from Jay Powell again. You know, the Fed did, to their credit, react very well after the event. Having said that, they probably should have at least had some idea of what was going to happen as they were seeing big time outflows in terms of deposits. I mean, you had not just, I think everyone talks about Silicon Valley Bank, but Signature Bank failed. You had First Republic fail and Credit Suisse failed. And people just kind of forget that or sweep it under the rug saying they were bought by UBS, but they were bought at pennies on the dollar by UBS at the behest of the Swiss government. So they responded okay to it, but those issues were there. I think if you go back to a couple of slides, we're not going to do it because it's difficult to see. I think one of the areas of stabilization, though, is on those deposit outflows. Those deposits outflows have slowed. And I think that's one reason we haven't seen a ton of bank failures over the last month or two. That is something that we'll have to watch going forward. Tom mentioned loan volume. You see on the right-hand side, you see deposits, and we saw that chart earlier. Left-hand side, you see loans, and that's starting to roll over. It's difficult to see, but it's beginning to roll over, still positive right now. But what banks are doing is they're making an assessment. They're saying, we got to be very careful now of how we deploy capital. We need to deploy capital in places that'll pay us back. And we need to deploy capital in places that exceed our cost of funds, which is now significant because rates have gone up. One area they don't like is commercial real estate. We talked about this before, but the green line is the non-performing loans in commercial real estate. This is from the Dallas Fed Loan Officer Survey that came out a couple of weeks ago, and we're beginning to see loan officers report more non-performing loans in commercial real estate. Consumer loans, interestingly, have improved a little bit. Kind of to Andrew's point earlier on consumer savings, average hourly earnings have improved. Consumers are getting in better shape, but commercial real estate is now funding with a higher cost of funds, and that's becoming difficult for them to make the numbers work. As a result, a lot of lines on this chart, but just look at the direction. Left-hand side is the credit standards. They're being raised significantly. So credit standards are much tighter. And that's especially true in commercial real estate. It's also true in commercial and industrial loans, and even consumer loans are a little bit tougher to come by now. The one area that hasn't tightened quite as much is residential real estate. And then you're also seeing a decline in loan volume as a result. So that's what they're doing with money. Where banks stand, this is an interesting proxy. So I'll explain this chart. This is the Bank Term Funding Program. Bank Term Funding Program was put in place by the Federal Reserve and the U.S. Treasury in mid-March, and it was done to combat the issues that we were seeing in the regional banks. And essentially what they said is a lot of these banks had invested in treasuries and mortgage-backed securities, both instruments that were trading at 80, 70 cents on the dollar. So AAA credit, but because interest rates had risen, the fair market value of that asset has dropped. And so what the Federal Reserve said was that, okay, we recognize that you guys have these assets, and now you just have to last a longer period of time so you get that pull back up to par. So that 78 cents over time will approach that dollar that you expect. And so the Fed said, we'll give you a liquidity facility that will give you access to those funds, and you have to pledge those mortgage-backed securities and treasuries as collateral. The liquidity facility currently costs 5.48% annualized. That's a very significant cost for a lot of these banks. And they're pulling over $100 billion on these liquidity facilities. So essentially what you can think of this orange line is the amount that and the need that the banks are willing to pay for just a few months of time to get their books in order get their balance sheets in right shape, and to meet deposit outflows. If this line begins to drop, then you'll have more confidence that banks can actually meet deposits. But right now, they're leaning heavily on this bank term funding program. Again, just over $100 billion in money that's been pulled on this line so far.
Student loan repayments. Big story that's going to probably have an impact on the economy, and we're going to do our best to try to quantify this. But you heard a lot of weeping and gnashing of teeth last week. It's probably from young people as the Supreme Court overruled the Biden administration's plan to forgive $10,000 to $20,000 worth of student loans to people that qualified based on income and types of loans and things of that nature. So that was thrown out. And so now what we are staring at directly is two things. Number one, that's off the table, just the broad forgiveness, at least for the time being, in the form that was initially presented. But the other thing is we've got to kick back up to actually paying student loans and paying these debts that were paused 3 years ago. So interest is going to start accruing again on these loans in September. There was a big pause and relief was given because of part of the COVID package. And then payments are going to be coming due in October. And this is going to have an impact. There's some direct impacts that we can try to kind of guess what the measurable meaning will be. And there's some indirect impacts. On the direct side, this could have a hit to GDP of, close to 0.5%. The expectation is maybe 0.2 to 0.4%, because specifically what is going to happen is young people are going to be spending a significant portion of their disposable income making loan payments again, something they have not had to do for the last 3 years. And that is going to hurt cross sections of the economy, such as the retail sector, travel and leisure, things like that. But there's also some unknown impacts. We don't know everything we could know about the additional leverage that people with student loans may have taken on. Picture somebody that was 23, they get out of college, they have these student loans, they make a couple months of payments. Back in 2020, all of a sudden there's a big pause hit. Well, they're used to paying that, right? They're used to writing these checks or paying these bills online. They're used to doing it. Did they take that money and then go buy a car and get a car payment and pick something else up? And if so, how are they going to continue to make that payment? Can they afford to pay both the student loan payment and the car payment on an ongoing basis? We don't know all of that yet. There are going to be impacts as it relates to the lower spending. Think of what young people spend money on. One of the biggest growers in terms of employment and in terms of wages over the last couple of years has been the leisure and hospitality space. Young people love to travel. They've not been making student loan payments. That's going to have an impact when they have to decide, hey, do I want to go on vacation with my friends, or do I want to go on my 8th bachelor's party weekend this year, or do I want to make my student loan payment? This is going to have an impact. And then you have states like California that were still sending out stimulus as recently as January of this year. Folks in those states are going to get doubly hit because, one, they've got a bill that maybe even for the first time they actually have to pay, or at least for the first time in 3 years they have to pay it. And there's not just money coming to their account because people voted to send them money. So it's going to have an impact. The two generations that are going to be probably most obviously impacted are Generation Z and millennials, but it's going to look differently, we think. Millennials for years were typecast as living in their parents' basements and not really doing anything, just playing their Xbox, but they actually own houses now. They actually have real jobs, they own cars, they have spouses, they have children. They've shifted a lot in terms of who they are, what they do, and what they spend money on over the last 5 years. They're going to be very, very locked in to where they are. It's very hard for someone with a family and a home to switch jobs or relocate and try to figure out a way to cover their student loan payments. It's harder to find a place in your budget to cover your student loans when you have a mortgage as opposed to living in your parents' basement. So the millennials are going to be pretty rigid, and they are going to have to really keep an eye on their big ticket purchases. They're going to say, hey, let's wait to buy that couch. Hey, let's wait. Maybe let's not go to as many concerts and that kind of thing. Expensive non-essentials are going to be put on the back burner. For Generation Z, they've actually got a lot of outs here, not the least of which is the fact that they should be in the period of rampant income increases. They are at the very beginning of their career. They have great outlooks in terms of increasing their income. They probably do not own a house. they're not quite as boxed in. So they're really going to be shifting the true discretionary kind of smaller ticket items, but it's going to have an impact on these generations. And we're really setting up what's called a K-shaped economy. This is a chart essentially of spending at the household level by different generations. So at the very top of the chart, you're seeing older generations. Older generations have really stabilized and kind of accelerated. They've actually, to an extent, weathered this storm and benefit. If you think of someone that's further along in their career, maybe even in retirement, and you think of the things that might actually be favorable for them over the last couple of years, there's quite a bit. Their house is probably worth more than they ever thought it was going to be worth, right? We've seen what's happened in real estate. If they own fixed income or bonds in their portfolio, they're probably getting more income off their investment portfolio than they have at any point over the last 15 years. If they're on Social Security, things like that, they're seeing big cost of living adjustments in terms of what they're taking home. And so they're actually doing pretty well. As you might expect, the young people have just fallen off a cliff. We always knew this would happen with Generation Z. They're the dark blue line that looks like they're just doing a barrel roll into the pool right now. But things have changed, and it changed really, really quickly. And this is data that is preempting everything we just talked about in terms of, hey, student loan payments coming this fall. So that's going to have an impact on the economy. We will know a lot more in the months to come. It will be very interesting to see what this looks like in 6 or 12 months once we have data after those loan repayments have resumed.
We've had a lot of questions on the US dollar as a reserve currency, especially following the US debt ceiling issues, debacle, whatever you want to call it, end of May. We actually did a full week. We do morning calls, just 15 minutes, and we actually did a full week on this back in 3 weeks ago, 4 weeks ago. Just quick summary, what is a reserve currency? It's basically a currency that's held by other countries. So right now, 58% of foreign exchange reserves in the world are denominated in US dollars. And that really hasn't changed all that much. Even when the euro came on board, there was a little bit of a decline between 2000 and 2010, but the US dollar still remained the dominant reserve currency. More recently, the British pound has done a little bit better. The Canadian dollar has done a little bit better. The Chinese renminbi has done a little bit better, but still has about 4 to 4.5% market share globally. But this is the real issue. What happens if the US debt continues to rise? Right now, we're 120% of GDP, debt as a percentage of of the US economy. We're at $31 trillion. I think we might now be at 32 trillion. By 2033, we might be over 50 trillion. So this is a question that comes up a lot. How is this going to get reconciled? I think one thing is, one source of optimism is this has happened before. After the British had the Glorious Revolution in 1688, they took on a ton of debt because now they actually had an ability to borrow like they hadn't had before. So they took on a ton of debt over the next 120 years. Took the debt to GDP to 250%. Then what happened is they said, well, you know, we actually got to pay our bills. They stopped the crowding out in the economy, which is basically when government does the investment and doesn't let private sector invest. So they kind of unleashed the shackles of the economy and let industrialization do its work. And all of a sudden, by the mid 1800s, you're back at 100% debt to GDP. Your deficits are in order. So this can be done. We'd like it not to wait until we get to 250% of GDP, although Japan's pretty close to there now. But how do we get that down? And I think people talk about defense spending's out of control, agency, non-defense spending's out of control. And you can have an opinion on that, that's fine, but the real issue is major healthcare. The economy is growing at, call it 4.5%, 5% per year. Inflation is 2.5% in CBO estimates. And then you've got major healthcare growing at 7% a year, expected over the next decade. So this is your Medicare, this is your Medicaid. And so it's just not an attractive talking point for a politician to come out and say, we're going to cut Medicare. But the fact of the matter is you don't have to cut Medicare, just grow it at a more reasonable rate. Grow it at the size of the economy, and then you're dealing with a much better situation fiscally. Obviously, that's a lot easier for me to say than actually do it. But that, if you're looking for an off-ramp and to take that debt to GDP into more reasonable levels, this is the lowest hanging fruit out there. Finally, in terms of how the US debt is held, the vast majority is held by US entities. The first three bars are the Federal Reserve, intergovernment accounts, and domestic investors. Then you got Japan, and then you have China's that little blue one. China has $870 billion of US debt. So we get the question, what would happen if China just decided to sell all of its holdings of US debt? Well, what would happen would look very similar to the last 4 weeks, where the US Treasury issued another $1 trillion of debt because they ran the coffers down. And so $1 trillion of debt came to market. It was absorbed relatively well, I think, Tom, by the market. We had really strong demand for our auctions last couple of days. So that's what it would look like. So I'm not too concerned about that. As far as the reserve currency just broadly goes, I would say reserve currency would probably be a function of US economic dominance. If we lose US economic dominance in a material way, then there's definitely a chance that we lose the reserve currency status. But I think that is going to be the path, not reserve currency goes while the US economy is still the dominant force. With that, Sam, AI.
All right, so a lot of people have heard a lot about AI. We got this quote up here from Stephen Hawking: "Development of full artificial intelligence could spell the end of the human race." I don't know that I'm qualified to argue with them, but in the long run, I think that that's probably, maybe it's true. I don't think it's going to be true. But in the short run, I think that the AI dominance is akin to the dissemination of personal computers in the 90s, which had this huge boost in productivity. And so, stay here for a sec. We got GPT came out earlier this year. That started all the buzz and the rumors. Then NVIDIA comes out with their first quarter results and kind of solidified that AI is the future. We once heard a guy speak. He said, if you can't predict the future, build it. Well, NVIDIA is the chip that is inside all these companies that are building these products. And so we can get some insight into AI's real dominance by looking at the results. And so after the first quarter, they come out, they report results, and they said in the second quarter, their revenue and their data center growth is going to double. So that's fantastic. They then went a step farther and said that the back half of the year is going to represent a substantial increase over the first half. So basically they said, we're just getting started. So we like to think of this similar to Sutter's Mill. The gold was found there before the California gold rush. Everybody flocked there. Well, NVIDIA is the only player in town in the NVIDIA space. They sell the best, picks, the best axes, shovels, pans, for mining this gold, and everybody wants a piece. And so every company out there, from the big tech like Google and Microsoft to Bloomberg's even talked about it, to Wendy's, as you'll see in a second, and basically every startup. And so, yeah. Sorry. So we got some examples here. So I know everybody can already come up with some ideas of how AI can, benefit you in your job. We got a couple of examples here. At top left corner, that's Adobe's Firefly. And so basically what that is you can speak text into a computer and then it spits out an image, and you can refine the image based on what you're looking for. If you're in the creative space, it'd probably be best to learn to use this versus trying to fight a computer, thinking that you can do it better because you can't. Netflix, you think of Amazon, Google, YouTube, all these guys have these recommendation algorithms. They're going to use these AI tools to make their algorithms better so that they can convince my wife to buy even more stuff from them. We got Wendy's. They're talking about, ordering to a screen, just speaking to a screen versus having to order through a person. So that obviously has huge cost efficiencies. Teenagers, maybe no longer get to work there, but that's just kind of the way it goes. And so, speaking from experience, we've used ChatGPT here. Me and Harrison have a good bit, and the things that it's helped us do is really impressive. You know, a lot of people are worried about tech. It's been going on for decades. People are worried about tech replacing their job, and it's something to be worried about. But the thing is, it actually works for the whole economy, because if you lose your job to ChatGPT, you then have to go learn a new skill, a new trade, which then really it increases the total factor productivity part of the GDP growth formula. So then GDP goes up, stock market goes up, everybody makes more money. It's all good for the whole. In terms of mitigating fears of AI replacing anybody's jobs, like I said, me and Harrison have done a lot. It's helped us a lot with our coding, but you still got to know what you're doing. It can get you 80%, 70% of the way there. You still got to know what you're doing. Sometimes you got Google Stack Overflow or whatever to wrap it up. But yeah, so I think it's the future. You know, NVIDIA, we think that there's just going to be increased ownership in that stock. I think it's similar to, I don't know how many of you guys would really remember this, but blockchain technology with Bitcoin. And then when Facebook came out and talked about the metaverse, when that happened, every single company then said, how many times can I say metaverse in my corporate call, my earnings call? How many times can I say blockchain in the call? And it's companies had no business even talking about, but they're like, we have to say this because this is what investors want. This is the future. How can we prove that we're a part of it? The difference is ChatGPT came out. Metaverse was just an idea. There was no product. ChatGPT is an actual product. We have, as you can see, actual products that are being used. And so we actually think that this will continue forward. And again, NVIDIA is just going to power it. With that, I'll hand it over.
All right, so wrapping everything up, and kind of getting to the finish line here. What is our market outlook? And oftentimes when we do our morning podcast on our walk back to this side of the office, Ben and I talk about how there's a lot of cognitive dissonance right now. There's a lot of ways this market can go, and some of them are diametrically opposed. I mean, even the conversation about who in the economy could benefit going forward, it could be different for different people. It's almost, you know, the cognitive dissonance is like, you know, I don't like Georgia fans, but I like many of you. You know, there's a diametrically opposed. So it's something to consider. I mean, if you think about, you know, the Fed could land this thing and we could have a soft landing and the economy could be fine. On the other hand, they could overshoot, raise too many times, and this economy could crash. Those two things are entirely possible from where we are right now, and they're diametrically opposed. You know, and how are we going to navigate those scenarios? There's a lot of different opportunities, but there's also a lot of risk. So one thing we really have been hammering lately is that, you know, this idea that America's retirees are investing more like 30-year-olds. And that's a result of low interest rate policy. Over the last, you know, 15 years, since 2008, rates have been exceptionally low, zero interest rate policy, negative interest rate policy overseas. And so bonds have really been pushed out of, you know, the places people want to invest. The amount of bonds that retired people own is much smaller, but that's going to change and it needs to change. And I think it's also a potential risk for many people who are retired and not thinking about dynamically changing their asset allocation now that yields have risen. You know, there's no real sense, historically speaking, that a 7-year-old man should have 80% stocks. Well, it makes a lot of sense if there's absolutely no yield in bonds, or if they're not at a high tax rate, or they just don't fit in their portfolio. And that's something we need to be evaluating with each and every client. So the first, hang on, not too far. I don't know how to go back. There we go. We need to maintain the broad strategy, which is making sure we have an allocation of both. You know, we're using bonds as the balance of the portfolio, income generation, and limiting volatility. The second would be, what are the needs of the portfolio? We have a lot of clients that are approaching retirement. Well, now might be the best time in their adult life to be adding fixed income to a portfolio, because you can buy bonds and mature at the end of this year paying 5.4%, which would be about 10x what you could buy on a 10-year bond, 6 months ago, or I guess a year and 6 months ago in the middle of COVID, when the 10-year treasury was at the lowest of all time. And then the third piece is optimizing within individual asset classes. People always talk about a 60-40 portfolio, 60% stocks, 40% bonds. But within each piece, you can do 60-40 of each. I mean, think of the equity side, you could have 60% aggressive, 40% conservative. And you can do that on the bond side too, especially now that we've had a shift in the mix of where the relative value is in the bond space. And so we can sit down with you and say, hey, how do we need to change our allocation? Are there opportunities on the fixed income side that weren't there before that could say, hey, I can lock in for the next 4 or 5 years at upwards of 4.5%, 5%, and not really be taking the credit risk that we saw before. There we go. So one thing that's different than usual, we've touched on this in the past couple macros, is that we are in an inverted yield curve scenario, which means that you get paid more for short-term bonds, you get paid for long-term bonds. On the bond desk, we call that incremental yield, which is, if you want to lock you up for 20 years, you want to get paid more per year than you would for 20 months. And we are completely backwards right now. I mean, like I said earlier, you can get 5.4% on a bond maturing at the end of this year. You can only get 5% going out for probably a year and a half now, and you can't, even touch 5% anywhere on the 30-year. And so we need to use this as an opportunity. We need to shorten our duration. We need to take opportunity to buy these shorter term bonds, because if we get to a normal shape on the yield curve, really either way, on the diametrically opposed options, which is one, the Fed cuts rates, that opportunity is going to go away. You won't be able to buy those bonds. If rates maintain where they are, we'll probably see a normalization of the yield curve, which would mean that there's typically a 200 basis point spread between the 2-year and the 10-year. Well, the 2-year is at 5%. That means the 10-year could go to 7%. So you don't necessarily want to be going out and buying 10-year bonds at, call it 4% on the 10-year, because if it goes to 7, that's a 30% loss in bond math in a very short period of time. So we need to be very dynamic in terms of where we are buying bonds, for who, and at what prices. So munis, which has long been our bread and butter, have been historically attractive in the past, but at this point in time, just in the way that the yield curve has moved, the front end of the curve, there's almost no value in buying muni. If you buy a municipal bond 2 years long, even if you're in the highest tax bracket, you're probably going to be going pretty short on a treasury. Treasuries are just extremely attractive on the short end. There is value on the long term if you're in the highest tax bracket. In the 10-year range, on a tax equivalent basis, you're getting upwards of 6, sometimes over 60% tax-free. But the downside is, you are taking on that duration risk. If the yield curve normalizes, there is some potential downside there. Mortgage-backed securities continue to be historically attractive. They're difficult to buy for most clients, especially on the bond portfolio if there's not size, but we do have some instruments that we've been using to get that exposure. But again, if there is an upside scenario in rates, you have that buffer where you're buying so much higher than the treasury. There's opportunity there, and they also amortize every month. Every time you pay your mortgage, that bond becomes a little bit smaller in your account. And we like that because you're not going to be in a scenario like First Republic or Silicon Valley Bank where you're going to be extended by higher interest rates. In fact, your yield gets better and you're locked in for longer at higher rates. And so that's an attractive structural piece of mortgage-backed securities. I think we missed a slide here at some point. But suffice to say, there's plenty of opportunity out there. We need to be building in the fixed income portfolios for the first time, I think, in a long time.
Yeah, we're like the Fed. We're working on a lag right now.
Yes.
On the equity strategy side, again, kind of like what we said at the beginning, working on cash flow companies, and especially low or no reliance on financial markets. We don't want to have a big hurdle of a company with a lot of debt with a balloon payment coming up in 2024 and then having to refinance that. That's what we want to avoid. What we do at Narwhal is we do active management. So this is kind of talking our book, but with so much concentration right now, this is a little bit difficult to see. But when in subsequent years after the market has been so concentrated in certain stocks, it actually sets up favorably for active management. And this kind of fits with our broader thesis that, on the corporate side, you got to make smart decisions with your money now. It's not just deploy as much capital because money is free. Now it's deploy capital in good opportunities because money has a cost. And that goes the same with selecting investments, whether it's equities, whether it's fixed income, it goes across the board. So what we have is we have a Narwhal Capital universe. We track 75 holdings across price targets. The orange bars, which have dipped negative more recently, indicate what that net buy rating is on stocks. So right now, that's a negative 18%, which means it's more likely that in our universe, we have a sell-rated stock than buy-rated stock. Having said that, we still have 25% of the companies that we follow registering buy right now. So there are opportunities, as Jason's going to talk about. Some of those opportunities, though, you have to really make make sure that we're doing our work in terms of getting businesses that actually do create.
So like Ben said, right now we do have about 25% of the stocks that we follow that are a buy, but for most of those, there's a good reason that they're a buy when the market's been so strong this year. So an example of that is Google. Sam already talked a lot about ChatGPT. Microsoft actually was one of the first investors into ChatGPT, and they have control over it now. And historically, Google has operated at a monopoly in search. I'd be surprised if anyone here doesn't regularly use Google when they're searching something on the internet. And all of a sudden, Microsoft came in and backed something that could be the first real credible threat to that monopoly in decades. And they've already started incorporating into Bing, which is their search engine. And so when we evaluate a stock, one of the things that we look at is a Warren Buffett coined term called the economic moat. And going from a monopoly to a real competitor is a threat to the economic moat. That being said, we think that there are reasons that the market has discounted that threat more than it should. So for example, ChatGPT in the last month has lost 10% of their users, while Google's equivalent called Bard has actually still been growing in the double digits. They're growing from a much lower amount of users, so that does make some sense that they're seeing a higher growth rate, but they are seeing a higher growth rate while ChatGPT is losing. And one of the reasons for that is the usefulness of ChatGPT is still somewhat limited compared to Google's offering. So ChatGPT, if you've ever used it, it's pretty good at giving you like broad information and presenting it in an easy to digest way. But if you ask it a very specific question, it struggles, where Google is very good at answering specific questions. And the reason for that is because Bard has real-time access to the internet today. So if you say, who won the Braves game last week, they can tell you. Versus ChatGPT, if you said, who won the Braves game last week, they'll say, we only have information up to September 2021. And so that gives a lot, that limits the uses for it a lot. Now, they'll probably get there eventually, but for now, we think that Google is going to be able to build off that competitive advantage. And so kind of how Tom was talking about how we value stocks based off their cash flows. So the model that we use for that is agnostic to all these stories and news updates that are going on. So that model gives Google a price target of $180. The stock's about 120 to 130 right now. And where our role comes in is saying, okay, we have this information that the model doesn't have, but how can we bounce that with it screaming that it's a buy more than most other companies out there right now? And we think that Google is well positioned to overcome some of those challenges. And then the other example right now is Goldman Sachs. So Goldman Sachs problems right now come more from the macro and the management. The macro is pretty obvious. We've talked a lot about bank failures during this presentation, and Goldman Sachs is obviously a bank. And so the dynamics at play that threaten smaller banks and have taken some smaller banks down also hurt Goldman Sachs profitability. But we're not calling for Goldman Sachs to fail or anything like that, but their profit is hurt by the same dynamics that hurts the smaller banks. And then also historically, Goldman Sachs has been the leader in the banking industry in IPOs and M&A activity. And right now, I think we've talked about in prior macro presentations that M&A activity and IPOs have significantly slowed down compared to the prior couple of years due to the high interest rate environment. So they're losing a lot of money in that regard as well. And then the other kind of more interesting thing that's hurting Goldman Sachs is their management. So there's been a lot of concerns recently about the CEO of the company, David Solomon. A couple of years ago, he started this big new venture to get into consumer banking that you may have heard of. They started this division called Marcus, and they also bought this company located here in Atlanta, actually, called Green Sky. And it was basically a complete disaster, long story short, for them. And recently they started to sell off those assets at a significant loss. And part of the reason that the partners of Goldman Sachs and the board think that that happened is that they've been kind of getting onto David Solomon's back recently about how he's spending his time outside of the office. Specifically, he's been traveling the world, DJing festivals and parties. He says it's his passion, and he's just like anyone else. But I think it's safe to say that he spends more time out of the office than Jamie Dimon or his peer CEOs of these huge banks. But that being said, using the same model that's agnostic to all these issues, Goldman Sachs is about $380 to $400 price target in our universe, and it's trading in the low 300s right now. So a lot of what we're trying to do is find these opportunities where we think that the market, has a justifiable reason to have these stocks at a cheaper valuation, but where it's cheaper than it should be and where we can capitalize on the opportunity there.
Thanks, Jason. Finish off with a little bit on alternatives. Private equity and real estate are two areas where we're very concerned or at least cognizant of the financing realities there. So you really have to have high standards in both of those sectors and a little bit of a unique view. Commodities, the interesting thing there is oil. I think a lot of people are interested in that, especially with the U.S. now trying to refill the Strategic Petroleum Reserve, OPEC cutting. But a lot of that's going to depend on China's reopening. And right now that's not going so well. So that's one of the reasons oil prices are relatively low. And then currencies, US dollar has been pretty strong year to date, but actually we've seen a lot of stability in currencies, which is good globally. So these are the decade returns in public markets, equities and fixed income. The beginning year is on the left, so 1993 to 2003, et cetera. What we did was we said, okay, well, let's go from 2023 to 2033 and kind of assess where we might go there. And so we looked at GDP assumptions. We said, let's say sales grow in line with GDP, and let's say we don't have much leverage on the earnings side. Now, if artificial intelligence really kicks off, you might get earnings per share growing faster than that. But you basically add that all together and you're looking at probably a 7.5. I think that's probably a relatively low conservative number. So maybe you get to 8.5% over the next decade in stocks. But what is most important here is on the right-hand side, you have 5% prospective fixed income returns, which would be the highest since the 1990s. So that creates really interesting dynamics for a portfolio. So if you look at it in terms of a 60-40 or 50-50 or an 80-20 portfolio, in the last 2 decades, the only way you were really getting returns is if you had equities. If you didn't have much equities, you just weren't getting returns. Today, you can get a similar return on a 50-50 or even a 60-40 portfolio over the next decade. But you're doing it with a more balanced source of that income. Rather than just relying on the equities for growth, you can now get some in fixed income as well. So I actually think that's pretty favorable, especially for people who are approaching or in retirement right now. You now have a more diverse way to get that return. So with that, we'll just have a couple quick notes. I don't think this updated, but I'll just give you guys the quick update. Mo Reza joined us full-time back in May. He graduated from University of Georgia. So Tom's a big fan of Mo. Andrew Wilson joined us on the 401k side and the machine, right? Yeah. And then also congratulations to Andrew, who was promoted to president of the firm very recently. So congratulations to Andrew. With that, take any questions. Sorry, we went a little bit long, but happy to answer questions as you have them.